Greetings and good morning. Welcome. I was hoping to get this video out a little bit sooner, but unfortunately my work schedule did not permit that. As you can see for the title, we're going to deal with understanding taxes. Obviously, based on the tax codes and stuff like that, this is a very, very complicated topic. If you need help with your taxes, as I've said in previous videos, go seek a professional. These videos I have are just kind of a cursory overview to kind of help you in case you're not familiar, or maybe give you some small tips and tricks or direction of what to look for. So as we're diving into taxes, obviously this affects every working adult. Whether this is your first job, you are running a business, even managing your retirement income, understanding the taxes, properly getting in depth into them can help you save money and give you a better plan when you're budgeting over the long term. It can help you make smarter decisions. So, as I said, I'm just trying to make kind of simplify all the tax portions from your different brackets, deductions and credits, and just show some practical ways to keep more of your money throughout the year. So first question, why does this matter? Well, if you've been paying taxes for a while, you definitely understand why understanding your taxes and everything that comes with that, why that's important. Most people are probably overpaying on their taxes throughout the year because they would prefer that refund next year. But you may miss some opportunities. If you're overpaying, if you're not delving into it, you may miss some opportunities just because you don't understand the system, and it is a very complicated system. If you understand it and can take advantage of everything, you can increase your take-home pay. You can learn through this process to maximize your deductions and credits. Avoid costly mistakes and penalties. Obviously, nobody wants to be audited by the IRS, being the worst portion of probably any of this. And then, again, as we talked about, planning better for your long term, for larger purchases, for long-term savings and stuff like that. So different types of taxes. First, you have income tax. So it's money you earn from any job you have, whether it's your wages from your job, tips, business income, that type of thing. Payroll tax, Social Security and Medicare, and that's on your employer to withhold from your paycheck. Or if you are an employer or planning to be one, understand you need to look into this aspect of taxes and how to withhold those from your employees. Sales tax is put on goods and services at the point of sale. Property tax paid on any property you own, whether that's your home, whether that is cars, what have you. And it's typically based on the assessed value, whatever your county or possibly city assess the value of your property at. And there are tips and tricks to reduce that burden, having it depreciate in value over time, stuff like that, being able to write that off, especially for businesses. Capital gains tax is another one. If you have investments, whenever you sell your stocks or any other investment, whatever the difference is from the purchase price that you had versus the sale price at time of sale, that difference is called a capital gain, and you pay taxes on that difference. And then there's, if you are at that point in life and you have an estate or inheritance taxes that you're passing your wealth on afterwards, whoever inherits that will be required to pay that tax. Okay, so there are different tax brackets. I'll try to break these down a little bit here. And the tax brackets are based on your income, and it's divided into chunks. And this is where a lot of people misunderstand how taxes are applied as you go to different tax brackets. The U.S. has what is called a progressive tax system. Um, you have different brackets for your taxes. Um, so, say for example, the first, like say 25,000, you'll pay. I think it's actually for the first 12,000, you don't pay any tax. You're so poor that you don't pay anything. If that's all you're making is 12,000, yeah, you don't pay taxes, but you're probably barely existing. And then the next, I want to say like 20, 25, you're paying a certain portion. So all you're paying, when you start paying taxes, you don't pay on the first 12,000 that you make. The next, say 12,000, you are paying a percentage tax on that portion. Not, and say it's 1% tax. Okay, you're paying it only on that 12 to say 24,000. Make things simple. You're not paying the 1% on the entire 24,000. So the next bracket up would say be 24 to 36. I know that's not the brackets, but you can look those up and kind of get an idea. There's 7 tax brackets in all. So the next, say 24 to 36, say it's a 2% tax bracket. So you're paying 0% for your first 12,000. You're paying 1% from 12 to 24, and then you're paying 2% on 24 to 36 income. So you're going to have 3 different levels of taxes that are going to be calculated, and it continues on like that. Now, obviously, the 1-2%, those are just for demonstration purposes. The tax is actually higher than that. And then at the upper end, it's anything above like $700,000, you're paying additional tax on that. So you could have 7 different tax amounts that you're paying based on what your income is. Your marginal rate is the highest rate you would pay. So, say you are in the $50,000 to $60,000 range, whatever that rate is, that's your marginal rate. It doesn't count everything below that. That's the marginal rate. Now, your effective rate is your average rate across all how many ever tax brackets you fall within. If you fall within 4 of them, 6 of them, or all 7. Your average across all of that is your effective rate. So different deductions, yeah, and credits. So your tax credits, first of all, they directly reduce the taxes and do not depend on the tax rate. Whereas deductions reduce the taxable income. which depends on the marginal rate. So as I talked about, the marginal rate depends on what tax bracket you end up falling in. You can take deductions, um, within that tax bracket, or whatever your highest tax bracket are. So deductions, first off, you have the standard deduction. It's currently 13,000 something for individuals and about 27,000 for couples. So as you say, we talked about earlier, if you're not paying, your first 12,000 is non-taxable. Um, so obviously, you're getting the full deduction. You're not paying taxes. Mortgage interest is another deduction. So if you own a home, the mortgage on that is tax deductible. Student loan interest is tax deductible. Charitable donations are tax deductible. And medical expenses above a certain percentage. So you'll have to do, again, talk to your tax professional. It has to be, I think, greater than 10 or 12% of your total take-home pay. I believe so. Your total income. So if I remember correctly, so say you make $100,000, you have to have more than $10,000 in medical expenses, and then anything over and above that is the deduction. So your first 10,000, just say for example, your first 10,000 is a non-deductible expense. I think kind of confusing, but you don't start that deduction until you get over that 10%. It may be on the whole amount. I haven't had time to go back in that. Luckily I'm healthy enough. I don't need to look into that deduction. Give me another 10, 20 years. We'll see what that looks like. Tax credits, as you said, they directly reduce your tax amount that you owe, and can be more valuable than tax deductions. Child tax credit is one. Your earned income credit and education credits, like American Opportunity Credit, different ones you got to go into. So be looking for any credits that you have that can, as I said, that more directly affects and reduces the taxes that you owe. All right, next, withholding, filing. Again, your working life, you know your tax withholdings. You do that with your paycheck, so you can calculate over time the best amount to withhold to alleviate your tax burden at the end of the year. You can decide whether you want to pay into or get a refund from the government. So every paycheck you get, there's taxes withheld. How much depends on your W-4 form and how you fill it out for your job. So first and foremost, withholding too much. Most people do prefer to be in this column, in this category, withholding too much, because they want to get a big refund at the end of the year. The catch is you are giving the government a tax-free loan. So it's that balance over time, learning to tweak to where optimally you're not getting a refund and you're not paying the government anything. Your optimal target is zero. Hitting that is almost impossible unless you do some sort of a payment throughout the year for your taxes. And withholding too little, of course, means that you will have to pay money when you file. Most people don't like being in that category because usually it's not just $5, $10. They're paying thousands, tens of thousands of dollars or more at the end of the year. So tweak that throughout the year. Pay attention your taxes each year. Do the calculations. Talk to a tax professional have them help you understand how to go about maximizing your take home pay and minimizing your tax burden at the end of the year. I do tend to try, personally, I do tend to try to err on the side of a higher take home pay. I don't mind paying at the end of the year, even if it's, $1,000, because as we said, that's an interest free loan to the government. I want the maximum I can pay, or I want the maximum take home pay. But again, it depends on your situation. So talk to a tax professional, or kind of learn everything about it yourself. Filing season, obviously, as we all know, January 1st to April 15th. Obviously, that just passed, so hopefully you already have your taxes in, or you have filed an extension. Two different ways, well, really three different ways to file is your software, like your different tax software that you can purchase, or online versions of it can help you fill out your taxes. If you have simple taxes, if you have just a 1040 easy day, that's the simplest. As you get more complicated, you have to go to another option as a tax professional. Any of these major agencies out there, or just somebody that's a certified tax professional. Make sure you verify their certifications, of course. And I do believe the IRS has their own. You could file directly with the IRS. Most people are not going to do that. It's much more complicated. So strategies for lowering your tax bill. Contributing to your retirement accounts, your 401k, your IRA. Those will overall reduce your tax burden, and as we've talked about in previous videos, give you a better nest egg for your retirement. Health savings accounts have kind of a multiple tax benefit. The contributions are tax deductible. They grow tax free, and your withdrawals and medical expenses that you pay from your health savings accounts are tax free. So, kind of a triple threat there, if you will. If you have that option within your company, and you have high medical bills, but you don't have a specific plan that you can work off of, having a health savings account could be quite beneficial. Flex savings account, it's again pre-tax dollars toward your healthcare expenses. Just different. It's a different from your health savings in that they don't grow, and I don't. Yeah, they don't grow. I think there's some other subtle differences. I'm not well versed in those plans. Education savings accounts, your 529 plans. If you know that your child is going to go to this university or that university, you can go ahead and start contributing as soon as they're born. And that way, by the time they get to college age and are ready to go, their expenses can already be paid for. As we've talked about, planning ahead of time, paying over the course of 10, 15 years toward that is wonderful if you can manage to figure that out for yourself, and you know for certain. Other ways to reduce your tax burden, businesses, side hustles. Learn the business side of it. If you're going to start a little home business, you can deduct part of your home office from your taxes. Mileage, if you're a business that you're starting, your side hustle requires you to drive, you can deduct the mileage. I think the recommendations are that you have a specific vehicle for the business. That way, not only can you deduct the mileage, you can deduct the depreciating value of the car or whatever vehicle you have from your tax burden. Uh, Other business expenses that you have, um, if you have a phone plan, you can deduct. If it is the phone is strictly for the business, you can deduct all of it. You can deduct a portion of your personal cell phone from your business plan. Uh, if you travel a lot, you can deduct other like airline miles. If you travel by train, any travel expenses can be deducted. Meals. Um, there's a long list of business expenses that, again, if you are planning a home business, part of the American dream, talk to a tax professional. They can help you understand better how to deduct those expenses, which ones you qualify for, which ones you don't. But the key with all of that, because it is a business, you keep all your receipts. Uh, File them, and you have to keep them for like 10 years or more. I think 10 years is the recommended, so that if your business gets audited, they're going to go back over 10 years. They're going to want to know everything you've spent money on within your business. And the same applies to your individual income tax. Uh, if you're just a regular W-4 employee. So keeping your records for all your expenses, your deductions, your credits, keeping all that filed for about 10 years, each folder per year, so you can go back. Hopefully you don't get audited, but prevention is the best medicine. Common mistakes to avoid: obviously filing late or not at all. Um, just start preparing near the end of the year. It's not a surprise. January 1st, April 15th, every year. Start preparing everything you can in November, December, and then January start hitting it hard. I know some places you don't get your W-2s until like the end of January, and certain other documents from different entities don't come out till February or even March. Just be aware of those dates, and have your taxes ready to go so that when those documents come in, you can input them or send them to your tax professional and move on. Filing late, filing not at all. I mean, I'm sure with all the advertisements you hear on the radio, owing $10,000, $100,000 or more in taxes, the IRS is they're the ones that caught Capone, because of failure to pay taxes. The government will come for its pound of flesh. So pay the government, or find ways to reduce your tax burden so much that you don't pay anything. Not reporting all your income. Again, keep good records. Keep all your receipts for any income you have, side hustles, even keeping if you receive a gift of cash, $10,000. I think it's $10,000 or more. You're going to have to report that to the IRS as income. So keep all those records. Forgetting to claim deductions or credits. Again, this is where I highly recommend a tax professional if you are not one. They can help you maximize your tax deductions, your credits. And don't be afraid to go to multiple tax professionals, get a different assessment, find the best one that works for you and your situation. It may cost you more up front, but in the long run, it will save you a lot more money. Keeping good records. Make sure you keep the good records. Keep any and all receipts. Keep your W-4, your W-2s, W-4s. Keep everything. for income, expenses that are related to your tax burden, uh, tax credits, anything. Keep it all. Keep folders. Um, be very detailed, or as detailed as you could possibly be. And then another one, it's kind of silly, but ignoring letters from the IRS. Right? If they're contacting you, it's probably for an audit. Now, I understand nowadays that they're with the scams out there. That's a strong possibility. So, if you do receive a letter, I recommend contacting the IRS to say, "Hey, did you guys send me a letter, or is this a scam?" I have not received one of those, but I have received scam letters from other groups and organizations that the letter itself looked like a scam, and I called and verified, and yes, it was. You kind of know uh, after a certain period of time, or a certain experience in life, what's a scam and what's not for your taxes. So don't ignore letters from the IRS, but verify they're not a scam. Especially emails, I would not trust emails from IRS unless you know specifically you're contacting an individual, and that individual within the IRS is emailing you. Taxes are complicated. It's not a perception; it's a reality. So finding ways to reduce your tax burden, learning the tax code early in life. If you're young, I highly recommend. It sucks. It's a lot, but learn everything you can about the tax system and how to maximize your take-home pay. Develop strategies to minimize your tax burden throughout the year, especially if you have a business. Learning all that can keep more money in your pocket and in your business, so you can grow faster. Um, I think that's pretty much all I want to cover for today. Again, taxes is a very, very complex topic. I mean, this could be days worth of videos covering all the different tax codes, because it's based on the state, it's based on your business, it's based on so many different things. So unless you are a tax professional, I don't recommend you doing this alone. Find a tax professional that can help you to to go through it, because hopefully this is their full-time job, is understanding the tax codes and the changes throughout time. Thank you for watching. Have a wonderful day.